My goal is to help you understand basic accounting and tax topics. So if you like what I'm doing, please subscribe. Let's go ahead and get into it. Today we're going to cover 5 tax tips to help save entrepreneurs real money. And I might even throw in a bonus tip if you stick around to the end. Tip number 1, if you just started a business, take advantage of startup and organizational costs. You can deduct up to $5,000 each of startup and organizational costs to get your business up and running. So the minute you start spending money before you're actually in business, I'm talking about you're buying things at Walmart, ordering things off of Amazon, make sure you track your receipts. Startup costs would be the cost to get up and running, and organizational costs would be the cost to set your business structure up. I actually have a separate video on the differences between the various entities, so make sure you check that video out. Tip 2, child labor. Sounds sketchy, but I promise it's not. Did you know that you can hire your kids to legitimately work in your business and then take a business deduction on those payments? However, when I say kids, I do mean under the age of 18. So instead of you paying for their movies and you paying for their extracurriculars or their football or their cheerleading or whatever, they pay for it themselves with the earnings that they made for working for you. Just pay them less than a standard deduction, and most importantly, pay them a reasonable salary. $5,000 for a teenager to run your social media would generally be fine, but you probably won't get away with paying a 3-year-old $12,000 to take your trash out. This doesn't impact child tax credits. They don't pay taxes on it, and you get a tax deduction. So check this illustration out. So in this business, they earned $75,000, and after hiring one child and paying them $5,000, in essence, they added back to their household $1,151. Now, this comes from the savings of federal income tax and self-employment tax. However, you have to be careful because they actually do need to work in your business, and you have to be able to substantiate it, but this can be a great strategy if you follow the appropriate rules. Tip 3. Home office. Way back when I was in school, I remember my professor saying, absolutely do not take the home office deduction. It's an immediate audit trigger. However, over the last 20 years or so, the IRS has softened their stance. And it's partly due because the new world order of how we're working from home and people legitimately are working in their home offices. So this is a great deduction because it essentially takes non-deductible personal expenses and then makes them a business expense. So you have a couple of different options to do this. You can do the simplified method where you take $5 per square foot of your office up to a max of $1,500, or you take a little more complicated approach and you do the actuals. Actual expenses, you allocate a portion of your actual expenses to your home office and then you deduct that. Now, the actual ones is a little more complicated and you do get into recapture and stuff like that, but it can be a great deduction if you know what you're doing. Tip 4. Travel. If you do it correctly, it can be valuable if you follow the rules. So lodging, 50% of the meals, sign me up. So maybe you have a rental property in another state or you're searching for leads. You can deduct the trip. The key is if the trip is 100% for business, you generally won't have any issues. If it dips below that, you'll probably have to allocate a certain portion to business and personal. Just make sure you review publication 463 and talk to your accountant and then travel away. Tip 5. Meals. So I briefly mentioned this in tip 4, but don't be afraid to deduct food. This has always been a hot topic, but meals are a great tool if they're used properly. Talking business with prospective clients, having a meeting with an employee, or traveling away from home, you can deduct 50% of your meal expense. This includes the meal, taxes, tips, etc. Just make sure you have your receipts and you can substantiate it. Bonus tip. So this is not necessarily a tip to save you money, but this is a tip to help you spend effectively. So you always hear people talking about a business write-off, but a write-off is only good if you were going to spend the money anyway. Instead of thinking of it as a write-off, think of it as a discount. The only thing you're saving is federal taxes, state taxes, and self-employment taxes associated with the purchase price. So let's just say that'd be around 40%. So say you run a janitor service and you spend $100 on a trash can just because you want to write it off. You're still spending $100, but you're actually saving $40, meaning you're still out of pocket $60. So the write-off is only worth it if you have to spend the money anyway. So hopefully you like these tips. Drop me a comment if you have any questions, and I'll see you in the next video.